Today, we've got the personal consumption expenditure data coming out of the US, which is tightly related to CPI inflation. We're going to find out what that means going forward. And then for the trading takeout, we're going to focus again on why the trend is your friend. Make sure you like this video and subscribe to ensure I pop up in your YouTube feed every day, giving you the best market commentary and tips so that you can improve your trading edge. So we've got a big day of data tomorrow. We actually have US retail inventories coming up first at 1:30. And then we've got the two big ones. We've got PCE, personal consumption expenditure prices, which basically is a really sensitive measure of consumer behavior. So CPI is one basket, but then you've got PCE as well, which is slightly different, but the Fed basically looks at it more because it's a higher frequency data set and more sensitive to the overall consumer, even though the media focuses on CPI. So that's tomorrow, and that should give a really, really strong indication of where we're headed for the CPI number. But you can see that the expected number is 2%. Previous was 2% as well. So no disinflation there. It's basically just flat. So it's neither inflation nor is it deflation. I guess you could argue it's disinflationary. It's probably rounded up anyway. But then after that, we've got the US GDP as well. And again, that is going to be key, especially for our idea with dollar yen. You know, we're looking at dollar yen from a perspective of the US wants higher rates or can achieve higher rates or at least stay higher for longer, whereas Japan can't really do it. Now, Japan did have overnight last night a slightly hotter inflation print, but that doesn't mean anything considering their trajectory for inflation is going down. There is, in fact, disinflation going on in Japan. And actually, more people died in Japan last year than were born. So about 750,000 births and 1.5 million deaths. That is massively deflationary for a nation because what you're seeing is the workforce just basically deplete. So these are longer term structural issues going on in Japan. So a lot of people that are suggesting Japan is, going to have some form of growth resurgence alongside their really easy monetary policy, alongside their lack of immigration as well. I just don't see it. So it's most likely just going to be a short-term blip if they do indeed change anything away from their, negative 0.1% deposit rate in Japan. So there's real problems with Japan, which just leads me to believe that if you're looking at it from a trading perspective, being long the dollar and short the yen, especially in the short term, makes sense. When we're looking at US growth, it's outperforming massively. And I think the Nikkei still has further to run as well, which implies that really any form of interest rate hike is currently off the table in Japan. So I think, let people get wealthy in Japan, let the domestic share buyers get a little bit wealthier, have the market go way beyond 1989 because we've only just breached that high again. And then maybe after that, we'll have a hike or even just a few basis points rise, in the yield curve control range. But for now, it doesn't make any sense at all. I think monetary policy should be fixed lower for Japan. We can see from the Japanese chart basically of inflation that it is heading downwards. So there's absolutely no real reason to raise in my view. Off of this, as I said, we're looking at that 151 level for dollar yen to push through. After that, we'll see what happens. But retail are heavily short the dollar yen as well for some bizarre reason. I think they're shorting into the strength thinking that they can catch the top when in fact all they're doing is building stops higher, which leads to the market cascading higher. So pay attention there and keep it tight. Today's trading takeout is on why the trend is your friend, and it's pretty easy. The market trends only about 30% of the time, and it mean reverts or trades in a range about 70% of the time. When it's in that range, it's far more difficult to make money just by sitting and doing nothing. Obviously, it's going up and down constantly, whereas when it's in a trend and it's a strong trend backed by really good fundamental tailwinds, the market can just keep carrying on. For example, when interest rates were at 0%, the market would dip maybe 30 basis points and you could just buy it again and it would keep going up another 1-2%. When you spot a trend, get involved and don't let it go. Only exit the trend when, it starts to enter down 10% levels, because that's probably when something really critical has changed.